In this section, I'm going to cover a technique that has become another staple with our swing traders who have gone through the entire program. These traders have made positive additions to their use of the Marcus Stalker's method, and we've decided that this would be beneficial to include so that other students can see how this particular technique is done as well. So this little tweak on the method allows traders to position themselves using lower time frames. The main purpose of this approach is to use a smaller stop loss for your swing trades. So instead of basing your stop loss on the daily chart, that frequently means using 80 to 150 pip stop, sometimes even larger, by using time frame intermix technique, you will be able to use a stop loss of about 40 to 60 pips instead. But please note that this requires quite a lot of skill. It's advisable to use market profile on lower time frames rather than only supply and demand rules. But I wanted to explain this approach in level 1 as well, so that you can understand that there is a way to position yourself for a swing trade through a lower time frame, thereby reducing the size of the overall stop loss, which in turn means that you will be more likely to get that 3-to-1 reward risk ratio trade. If you end up adopting this approach, eventually you will need to learn what the normal trading day looks like for intraday moves. You also need to be aware of how these lower time frame intraday moves relate to higher time frames. I will go over exactly what you need to look out for when you're in a trade already. So while the focus in previous lessons on top-down approach and life after the scoring table was more on trade locations, here I will be explaining how to practically execute a trade from the lower time frame and then what to do when you've already got your trade open. This lesson is named Time Frame Intermix because you will be using a mix of time frames, mixing them and matching them to make further trade management decisions. This, of course, will happen after you've identified a trading location from a larger time frame, and of course only after you've used a particular candlestick reversal pattern to enter your position. First thing to note is that all markets have a fractal nature. Now, I'm sure you've heard this before, but you may not completely understand what it means in practical trading terms. In the simplest way possible, this means that if you've entered a trade which has already moved in your desired trade direction, then whichever time frame you used should eventually show up on larger time frames as well. This is, of course, only the case if your trading idea was the right one and the market agrees with your choice. It means that you've managed to correctly choose a reactive supply and demand area. The idea of time frame intermix is that a trader can not only use a slightly lower time frame, such as a 4-hour, 1-hour, and in some cases 30 minutes and 15 minutes charts to enter their trades, but also to manage the trades by tracking what is going on larger time frames. And in this case, you are not aiming to keep a trade for a couple of hours. So you obviously need to identify an opportunity that will last you a number of days, or at least a couple of days. If you only choose to position yourself using the daily chart, your stop loss sizes will be anything from about 80 pips up to 120, 150 pips in many cases, which means that the duration of your trades will need to be 2 weeks up to 2 months to get the kind of move that will get you a decent reward risk ratio. In my opinion, this is way too long a time, and it's not really the point of Marcus Stalker's method, and it's not how we really trade. Yes, we do use supply and demand areas for trade locations, but as your skills develop more and more, I would expect you to move towards a more advanced way of trade execution. So levels 2 and 3 of the Pro Development courses will develop these skills in detail, but I wanted to set some ideas of the end goals when it comes to learning our methodology. The main takeaway from this lesson is that once you've used the lower time frame candlestick pattern to enter a trade, you will then be tracking a larger time frame for further candlestick patterns to see if the price is rejecting the area on the large time frames as well. One thing that you need to start working on is your exit rules, your exit strategies. I see way too many supply and demand traders that have set a supply demand based target of some opposing zone that they've identified, and this zone may have about, 5-6 times profit margin, which is a lot. But then these traders enter a trade and then they sit and watch their trades reaching 2 times, 3 times, 4 times profit margin, and then they also watch these trades turn around, go right back where they came from and hit the full stop loss. From a statistical point of view, this is just not good trading practice, and honestly it's terrible trade management. Statistically, any trade that has twice the amount of profit margin that you've risked on your trade, that you can hit with an overall accuracy of only 35%, that makes a decent system, very decent system. And then if you get a 2.5 times risk reward at the same accuracy, 35%, fairly low, you're actually looking at a steady 23% return per month using only 1% on each trade of your overall trading capital. But most supply and demand traders, they aim for these opposing zones for their targets, do or die, and this is not really necessary. Now, what is necessary is to set the maximum duration for your trades. That's how you get around this problem. You must start looking at your own trading as a trading system that needs to have some kind of a statistical edge. In cases when you have given enough time for your trade to work out and it's still not even at 2 times risk reward, then you must have a set of different exit rules. You must have a contingency plan of what to do if your trade target is not reached. Because let's face it, when the target is reached, that's easy. The trade worked out. You don't really have to say anything else. There's nothing to learn from it. The trouble comes when things don't quite go your way. So this is why you need to know what to do. Now, for intraday traders, exit rules will be slightly different, and they're thoroughly explained in levels 2 and 3. But for now, the main exit rule that you need to decide on, first and foremost, is your maximum trade duration. So max trade duration means that you will assign a maximum duration for the trade that you're willing to keep before deciding that it's taken too long to reach your original profit target, and you're booking it or taking it off the table on the basis that it hasn't done what it needs to do in a set period of time. Now, this rule of maximum duration can be a number of things. So one option would be to have a number of candles from the initial setup time frame where you first identified your supply and demand zone. So for example, if you enter a trade based on the daily supply demand zone and you decide that, for example, after 5 days, so you need 5 daily candles, if the profit target isn't reached, you will take the trade off wherever it is, regardless whether it's in profit or whether it's sitting at a slight drawdown. Now, it doesn't have to be 5 candles. It can be 3 candles, it can be 10, it can be 20. It depends on your style of trading. And also, you have to look at your previous statistics. So whatever your previous live performance statistics tell you that your strength is, i.e. how many winning trades you did and what was the average duration of those trades, that's how you can determine what this particular number should be. For me, I know that if I'm doing swing trades, I'm usually out in a couple of days. So for some of them, maybe 3 days. But for some of my intraday trades, it's never more than about 3 hours. Now, I do have a consulting service for existing students who have at least 50 trades over a 6-month period. We look at how your performance is over multi-day swings and how your performance is over intradays. We also look at which of your traded instruments is better multi-day or which one is better intraday. And then we also extrapolate what was the average duration on your winning trades and how you can tweak your strategy going forward. So if you are interested in something like this, then ping us an email and we'll send you all of the information, how it works, what kind of data we need, and what the lead time will be for your performance results. But do remember, the minimum sample size is at least 50 trades over 6 months period. Now, another way to use max duration, it can be as simple as just closing a trade at the end of the week. I used to do this. I used to close all of my swing trades on a Friday morning for London Open, because I know that Fridays can bring these profit-taking moves, which can wipe away any swing trade profits. In fact, violent Friday moves are so prevalent that they have their own name among us traders, and they're called Freaky Fridays. Here I also write you can have a particular day of week/month. Some of you might be wondering, why a particular day of month? Well, there is a thing called European option expiry, which happens every third Thursday of the month, which can also bring a complete reversal of the swing, wiping out your profits. Now, earlier I mentioned that some traders leave their trades on kind of do or die, leave to run for full profit or full loss, which can be an option if you find that your trades frequently do go to that 3 or 4 times risk reward. But I will be honest, I'm not really in favor of this last one. It's a somewhat an easier option because you're only focusing on the entries, and then you're kind of hoping that the move away will take care of the rest. But what the do or die exit rule is good for is that it makes you focus only on entries. But once you've got some experience under your belt, then entries should really become second nature at some point. So then you have to start getting better and then optimizing your performance. Finally, some people prefer to use price action based exits. Although these kind of exits are definitely the most advanced way of booking profits and best suited for shorter trade durations. But here they are anyways. So you can choose to wait for a 4-hour consolidation or an engulfing pattern. When I say consolidation, that also falls under the basic market structures, either phase 1 or phase 3. Consolidation usually has very uniform candle bodies, and it needs to go only for about 4 candles. Whereas phase 3 or phase 1, it can go on for quite a bit longer than that, and really has like small ranged movements, which overall don't bring any advancement in the same direction. Now, another note on the 4-hour consolidations. Sometimes these consolidations may happen if the market you're trading is not actually actively traded on that particular exchange. So as a conclusion, any 4-hour consolidations that you do see, please make sure that they've been made during the active trading hours for that particular financial product. Now, these next 2 exit rules pertain to market profile based exits. I know we've not done a market profile yet, but for now, all you need to remember is that if you notice overlapping of the distribution curves, overlapping of the value areas of market profile for minimum 3 days, this is a sign to take profits. And then another market profile clue would be if the market opens outside of the distribution curve to the opposing side. This would also mean that it's time to jump ship. Let's have a look at the actual setup and the process that you need to have in place for the time frame intermix technique to be viable. First thing is to identify your trade location from a larger time frame. I've covered this extensively in top-down approach and in the life after the scoring table lessons. So you want to have some sort of an engulfing pattern on a very large time frame, such as a weekly chart or even a monthly chart. So to clarify further, I know that I say don't diddle in the middle, but if you're on a high time frame like monthly or weekly chart, you don't have to be inside a Q point, otherwise we would trade twice a year. Not what we want. But you do need to have some kind of price action on those time frames to justify a bounce. And again, you're not planning to hold the trade for weeks and months. Instead, you're only looking for a reaction that will last one day up to about a few days, maybe a couple of weeks at most. But for me, I must admit, I haven't done a trade that has lasted longer than 5 days in years, mainly because the market conditions have changed quite a lot. So there's plenty of liquidity, but there's lack of momentum in the same direction. You have lots of up and down movement. And while it seems like that might be a bad thing, in reality, it actually allows us to vastly outperform the underlying movement of the product. Let's move on. If you are trading without additional market profile information, regardless of what's happening on the monthly and weekly charts, you really must have a daily Q point. Next, you should also ideally ensure that the price reaches a 4-hour Q point as well, which means it is likely going to be deeper into the daily Q point, giving you an additional zoom into the level and an opportunity to reduce your stop loss further. If there are no new Q points on a 4-hour chart, for example, you might be referencing an older daily Q point, then you may want to use the daily range exhaustions instead as a means to minimize your stop even more. Sometimes there will be occasions when the daily range has already been exhausted and breached by the time the price reaches a 4-hour Q point. In that case, that is an excellent opportunity for a mean reversion trade. In many ways, this is the ideal setup. Now, since I'm mentioning low time frames, obviously trading from a low time frame is much harder because your timing for the trade entry has to be quite reasonable. So what do I mean by that? Well, as a general rule, entering swing trades for the London session is not really advisable because of the way the normal trading day looks. But generally, if you're trading forex pairs, especially European majors, London typically takes the price one way, and then when New York Stock Exchange kicks in, it pretty much reverses that movement, in many cases completely pushing past London levels. Therefore, if you're planning on entering any Europe-related forex swing trades from low time frames, don't really care where in the world you're located. I suggest you only ever use New York Stock Exchange trading hours for your entries. Forex is a bit different than commodities and indices markets because commodities can be unidirectional across the sessions. Again, you need to know the behaviors of your financial products. That's why I tell people not to trade a bazillion things at once, because you will never be aware of this movement enough to learn the exact behavior of each instrument within a certain expected framework. Choice of low time frames. Depending on how skilled you are, you can use 1 hour, 30 minutes, 15 minutes charts. In some cases, even a 5-minute chart, especially if you're very good at recognizing weak candlestick patterns versus strong candlestick patterns. If the skill of recognizing weak versus strong candlestick patterns has never even occurred to you, then I do have a candlestick workshop that you may find useful. I'm not going to teach this here because that's the basics. So the only reason why I made that workshop is because we've had many traders come to us saying how they know how to read candlestick patterns, which very quickly turns into, oh, I didn't know there was a difference between a weak and strong engulfing. In order of probability, these are the engulfing patterns, of course, consolidating pattern, morning stars and evening stars, and inside bar variations. Now, once you've identified all of these conditions, you would then go into a trade, but you would need to add anywhere from 5 to about 10 pips to the stop loss based on your low time frame pattern. Additionally, the pattern needs to close outside of the 4-hour Q point at the very least. I've had a number of traders thinking that Q points are a minor probability enhancer in the method, thinking it's all based around supply and demand that we've all known from certain providers, but it's actually the other way around. This is why over the years this method got the name the missing link of supply and demand, because the scoring of the levels is important to ensure that there is a clean arrival, that you're not bumping into an opposing area, that you do have enough space from your entry to your target and all of that good stuff. But scoring levels in the middle of swings is actually quite pointless and doesn't really work. So instead of blindly executing the limit orders based just on scoring, I use the developing price action on lower time frames. Whether that's 15 minutes, 30 minutes, 1 hour, or 4 hours, it's down to your own skill level and style of trading. And then you will determine whether your level has indeed attracted the attention from institutional traders. And that is how you become consistent, by being able to systematically find setups that look a certain way on the chart and that have all the same conditions. So with that, let's have a look at the flow diagram to help you out with visualizing this process. Starting on the left, the very first condition that kicks off this whole process is to have an engulfing pattern on one of these time frames, monthly, weekly, or a daily chart. Then moving to the right, to the next box, you need to have a pullback to the conterminous line of this engulfing from the large time frame. This pullback to the conterminous line of the engulfing pattern is the reason why you would even consider a trade at that location. You're expecting a bounce to happen from there. So right away, the direction of the conterminous line will give you the direction of your trade. Bear in mind, this conterminous line can either be newly formed engulfing, but it can also be an old conterminous line or a supply and demand area that the price has arrived at. Then you would look at the daily chart. But if you are using a conterminous line from the daily chart, you will need to be at or inside a daily Q point by default. If you don't have the daily Q point, there is no swing trade there yet. Once the price has arrived at a daily Q point, you then need to go to the next box and the next lower time frame, which is a 4-hour chart. If there is no 4-hour Q point, then you at least need to ensure that the daily range has been already exhausted for the day. If the daily range is still not exhausted, it's probably safer for you to stay out of the trade. But if the daily range is done, you can then move up to check whether you're currently trading during the New York Stock Exchange hours. You can then drop down to an even lower time frame and wait until a strong reversal pattern appears. If you do get a strong reversal pattern, you then also need to ensure that the pattern closes outside of the 4-hour Q point at the very least, and eventually outside of a daily Q point too. If you're trading from an exceptionally small time frame and you see a very strong reversal pattern, but the price doesn't yet close outside of a 4-hour or a daily Q point, you can still attempt to trade, but then you will need to track a higher time frame to make sure the price eventually closes outside of that Q point. It means that once you've entered your trade, you will then switch to the next bigger time frame, looking to see if there is another rejection pattern. After that, you will rinse and repeat and keep doing this loop, and then this continues until you reach the daily candle close. If you get a doji or just like a really small candle, you stay in the trade. If the daily chart is not entirely clear, you may need to have another daily candle after that, so you will have to wait a full 24 hours just to see whether the rejection pattern eventually appears. If you get small candles, beginning of consolidations, weaker inside bars, but also variations of the inside bar, such as 3 inside outside pattern. So let's have a look at this process on another diagram. Simple one this time. Let's say that you've used a 15-minute reversal pattern to enter your trade. So in this chart, you actually jump to a 1-hour candle close, because a 30-minute candle close is not going to tell you much more different than the 15 minutes. So if there's no reversal pattern on the 1-hour chart, you will need to close the trade. If, however, there is another reversal pattern, you will then carry on to wait for the 4-hour candle close and then rinse and repeat. Now, once you get the daily candle close. If you still don't have a reversal pattern, you need to wait for the next day candle to close. And that's where that 24-hour waiting period kicks in. So you have 24 hours before you can determine whether to keep your swing trade or not. In a lot of the cases, if your position on those large time frames is not strong enough, your trade may not survive through the next day, especially if you've missed some major news. But if your trade is still alive by the end of the next day, you will then look at this second daily candle and once again ask yourself whether there is a reversal pattern. If the answer is yes, you will keep your swing trade and move on to planning your exit rule, making sure that you don't exceed your maximum duration time. Once this process is in place, you will then have the resolution of the trade, either by the trade reaching its intended price target, or if it's been going on for a while and still nothing, you will invoke your maximum duration rule and pull the trade off. Now let's have some examples. Here's a weekly chart of euro dollar reaching a bearish engulfing conterminous line, middle of nowhere. And obviously it's a supply area, but it's weakened by a number of things. Already a test of the zone, lack of profit margin, you name it. So it is a weak area. So by traditional supply and demand rules on the weekly chart, this would be a no-go. I'm going to mark this area with a red line. This is the view of the daily chart of that same area. Here is that weekly conterminous line from the previous chart. But now let's drop to the lower time frames. This is now a 30-minute chart, and if you can see, I put this crosshair here to show you when this move happened. So it was 6:30 p.m. GMT, so that's about 2.5 hours before the New York Stock Exchange closes. So it's fairly late in the trading session this time. So going through that process of waiting for rejection patterns, knowing that we had a sliding consolidation on the previous one, now we wait for the 1 hour close. So the result was the inside bar that eventually turned into 3 outside down. Now at this point, I want to say that once you've entered your trade already, you don't need to see a hugely strong pattern on every single time frame. But you do need to see some kind of a rejection pattern. Because remember, you're already in a trade, right? You're not looking for another perfect pattern to come your way. You already got that. That's why you're in a trade, presumably. So now you're simply tracking whether the price is moving in your direction. For some of these trades that happen late in the day, you may even find that the market closes and then the liquidity dies out. So by expecting, strong patterns to keep coming up, it's obviously not very realistic. Next up, a 4-hour chart. So what do we have? We have a flimsy evening star, but still rejection pattern. So you already saw this chart. This is what the daily chart looked like. And obviously, since the price has just reached that conterminous line and that daily Q point is the first day of it reaching this area, to expect the rejection on that very first day is obviously wishful thinking. So that's why I have that flow diagram condition that says you have to wait for the entire 24 hours before you see whether there's a rejection pattern on the daily. So now we must wait for day 2 and then recheck whether there's a reversal pattern. So now you waited for the entire 24 hours and you can see what's happened. In this case, there's an inside bar coming from the daily Q point. So now with your trade entry from that low time frame, you can now see where your trade entry was. So you notice the bearish engulfing during New York Stock Exchange hours. So we've entered the trade. You place your stop loss about 5 pips above the high of the pattern, and then waiting for 24 hours into the close of the next day. And this is what your trade looks like on day 3, looking at the daily chart. So already that second day, the trade poked at that kind of 2.5 times reward risk ratio. And then finally the next day, a very generous target of over 4 times reward risk, and that's only over 2.5 days trade duration. So using the time frame intermix technique is a great way to lower your stop loss requirement, to increase your reward risk ratio, and ultimately to cut down the time that your trades need to reach a decent profit. But please make sure you realize this is a technique that will take a while to master, because it requires you to be very rigid on the types of candlesticks that you choose for your entry. I was a bit reluctant to put this lesson out there despite many requests that we get from people about trading supply and demand from lower time frames, because without market profile, you may be tempted to keep doing trade after trade from a lower time frame each time you lose. And then on top of that, a lot of people will not be making the distinction between a strong and a weak pattern. And this is especially true for anything lower than a 30-minute chart, because at least when you're using a 30-minute chart, you naturally have to wait for at least an hour for like 2 candles to appear. And this is why this lesson comes with a caution. It should only be attempted once your trading plans start to reflect your competence in correctly speculating on the weekly market direction. Even if your trades in the beginning only go to 1-to-1 because you're using a larger stop loss, if your trades manage to survive for longer than 1 day or 2 days, that's a great start. From there, you can then begin to optimize how you trade. You begin to optimize yourself. The way to start optimizing your own skills is to start looking at a 4-hour chart entries first, and then as you get better at that, you can begin to use 1 hour and then time of day as well, so that you eventually get down to your desired time frame. Let's have a look at another example. This time I'm going to use a newly formed bullish engulfing conterminous line from the weekly chart. This was on GBP USD cable. In the week before that, you can see there was a bearish engulfing. And as you will see very soon, once I start to drop down through the time frames, those 3 reference trend time frames that I use, 4-hour daily and a weekly chart, will all show up. This meant that the uptrend is quite strong. If you also analyze this chart a little bit further back, you can see that the price has actually broken through a couple of supplies already. It's a weekly chart, so when this happens, it's pretty relevant. And when you get that, it means that trading from a Q high on the daily is not really an option. You must wait for the price to fall into the daily Q low. Anyways, moving on. So now on the weekly chart, there is a bullish engulfing, and I was looking at this newly formed conterminous demand line. And then for my setup, I also wanted a creation and a test of a daily Q low. So let's drop down to the daily time frame. On this daily chart, you can now see this red line where the weekly conterminous line was, but there are no Q points yet. You can see that on the same week, I was actually waiting for about 3 days for the setup. So this tiny little doji was the Sunday candle for the new week. But because of no Q points, I really didn't trust these little pops into the existing conterminous line. And this is where Q points can save you from doing stupid trades. No Q points on the daily chart, no trade. Simple. Now I waited another day for the setup. So on Thursday that week, well, it was this week because I just finished this trade, I finally got my Q points created, and it was a very quick visit to the daily Q point, all in 1 day. So as soon as this happened, I started to monitor the low time frames during the New York session for my candlestick pattern rejection. And I know this move that kind of drops down, creates the Q point and tests the Q point all in the same day. It might look super scary because it's this like massive black candle on the daily chart, but remember the day isn't over yet. So this candle is still subject to change at this point. So you have to have a bit of courage when you're trading. So let's drop down to the low time frame. I love my 30-minute charts. So what do I have? I have a strong inside bar, followed by a small consolidating candle, and then finally finishing with another push upwards and a bullish engulfing that makes a new high and confidently closes outside of the whole consolidation area. Remember, it's still not closing outside of the daily Q low. Okay, so when did this happen? It was 4:30 p.m. GMT. So that's 2 hours into the New York Stock Exchange session. I entered the trade based on the inside bar and the correct time of day. The next move was to wait for the 1 hour candle to close. Here it is, so it's another inside bar. The trade remains. Then I was tracking the 4 hour close. The 4 hour chart brings a weaker inside bar, which also happens to be a pin bar, but this pin bar is actually closing above the daily Q low. It put me in quite a lot of profit, and of course it meant that the trade will stay on. Now at this point we're coming to the end of the trading day for the New York Stock Exchange, so I expected to see the waning of volume, and it's also only day one of the trade entry. The whole day actually ended with a bear candle and a pretty massive buying wick, which comprised more than half of the entire length of the candle. So now I'm going to put my levels on where the trade was, where the stop loss was. Once again, remember it is day one, so on the daily chart, although this is a pin bar, there's still no definite rejection. So you have to wait for an extra day and then decide if you're keeping the trade or not. So now I'm going to switch down to the 30-minute chart to show you the trade entry with stop loss. So 30-minute inside bar that I mentioned, plus time of day was the final trigger for this trade. I added 7 pips extra to the low, so this is a relatively large stop loss for me. It was a 52 pip stop. And the reason why I didn't want to put a smaller stop loss was because I never really want to compromise the low or the high of the pattern. So highs and lows are created there for a reason. Additionally, if I had placed my stop loss higher, then the stop loss would have to be above the round number, the 130. And I mean, in this case, the trade was actually safe, but I've seen algorithms go for the round numbers very frequently. So by placing my stop loss below the round number, I'm in a much stronger position than your average retail trader. And over the years, I've realized that the best and the strongest trades are the ones where you can actually obtain your entry either below the round number for longs and above the round number for shorts. And here is what this trade looks like on the finished daily chart. So remember, this red line is where the weekly conterminous line was. This was the entire reason for this trade, but also then look how far into this whole area the price went to test the Q low before pulling back up. So it's very, very far away, this setup, from the weekly conterminous line. But because it was such a massive move, Q points enabled me to zoom into entire pattern from the weekly chart and then to identify the most likely swing extreme. As you can see, after day one, the trade was already at 1.6 times reward risk ratio. If you follow the flow diagram, you go do something else for the next 24 hours, then you would come back to see if your trade is still alive. And if yes, you would check for a rejection pattern. So day two, and the trade had already reached 3 times risk reward and created what looks to be the start of a consolidation pattern. So it's an inside bar, and on the basis that I had a 3-to-1 profit already, I took this trade off. Now let me explain why I put this your risk thing. If you're staring at any trade that has already reached over 2 times profit, by the end of day 2, you should just take it. Do not be what some traders refer to as, excuse my language, a dick for a tick. This applies to people who are looking at the target and it's kind of a couple of ticks away, but they still won't take profits because the target is 2 ticks away. And then usually what happens, the whole trade goes back and hits their stop loss. So for the sake of swing trades, this phrase also goes for people who chase a 4 times risk reward when you already have a 3 times risk reward staring you in the face. And you're still not taking profits because you're hell-bent on getting 4 times. So you have a trade with a statistical edge, just take it. Take it and run. Because if you stay in, and this indeed is the beginning of the consolidation, your risk is not just your initial stop loss. Instead, your risk is this entire move. Okay, and what do we call that? A negative risk reward. Jack the Ripper of trading accounts. To make this idea even more clear, you will be risking all of this profit if you decided to enter a trade again to get this tiny little bit here. So what is that? 0.25 times reward risk. Doesn't make any sense, does it? So don't do it, okay? Statistically, even on low accuracy, like I mentioned before, 35% is all you need on 2 times reward risk. Having the maximum duration rule does mean that some of your trades may end up only in slight profit. Some others might end up at 3 times risk reward. But overall, statistically, there is zero need to stubbornly wait for your original profit target. All right, I think I've tortured you enough with these charts. Time for the summary. So in this lesson, we looked at how to use a lower time frame to enter trades. It's a form of a confirmation trade rather than using a more traditional limit order from supply-demand areas. I then talked about the exit rules and why setting a maximum trade duration for an exit rule is super important. I then took you through the entire time frame intermix setup routine and show you the same in a flow diagram, further explaining some finer points. And we finished with a couple of examples that illustrated the fractal nature of the markets. But bottom line is that if you have correctly identified a trade direction, it doesn't matter which time frame you will use to enter, as long as you keep tracking the higher time frames as they develop, as more trading information comes in over the course of the next few hours. The examples also showed you the process of obtaining a trade and then looking for reasons to remain in the trade as the time frames got larger and larger, printing new but same rejection patterns. And that was it for the time frame intermix lesson.